What's the difference between a mutual fund and an ETF? We're going to explore that in today's video. A mutual fund, basically, it consolidates money from a group of different investors, and then it uses this pool of money to create a portfolio of investments. Now, this portfolio can be, assets such as stocks, bonds, real estate, crypto. It could be basically anything. And if I own shares in this mutual fund, this pool, basically I would own a piece of this portfolio of investments. Now, an ETF or an exchange traded fund, similarly, it's also a portfolio, a collection of different investments. And if I own shares in the ETF, I also own a piece of this particular investment portfolio. It kind of sounds like the same thing, doesn't it? Well, in many ways, they are the same. Now, the main goal behind both the mutual fund and the ETF is that it is a portfolio that is created to meet certain objectives. For example, maybe the portfolio is designed to track a certain index or a certain benchmark, such as the S&P 500 index. Or perhaps the fund's objective is to make money from buying and selling companies in a certain sector, such as energy or technology. Or perhaps the strategy of the fund is ESG investing. There's a lot of different funds that are created for different objectives, and the mandate or the objective of the fund will influence the kind of assets that is going to go out to buy and sell. So the performance of the fund, be it the mutual fund or the ETF, is dependent on the performance of the underlying assets in which it buys. If the underlying assets, the underlying investments that the fund invests in does well, then the value of the fund is going to increase over time, and so does my investment in the fund. The main difference between a mutual fund and an exchange traded fund is that the exchange traded fund is exchange traded. And what this means is that you can buy, sell, or trade ETFs anytime as long as the market is open. All you need is a brokerage account and sufficient capital, and you can buy and sell shares in an ETF whenever you want. You can pretty much transact in ETF shares immediately. Whereas when it comes to mutual funds, they are sold to you by your banks, by your insurance agents, by your investment advisor. There are limited avenues for you to access investments in mutual funds. And even so, the transactions are not going to be immediate compared to ETFs, especially when you want to get out. Another advantage of exchange traded funds is that you can see the price of the ETF immediately, whereas the price of mutual funds are only set at the end of every market day. So when it comes to ETFs, the price you see is what you get. It's a lot more transparent that way. Now, because ETFs are listed on a stock exchange, you can actually trade them in any direction. If you think the market is going to go up, you can go long or you can buy ETFs. If you think the market is going to go down, you can actually short shares in ETFs. Or you can make use of option strategies for ETFs that do have options on them. And that allows you to profit and benefit when the market goes up, goes down, or even stays sideways. But you can't do any of that with mutual funds. You can only buy them, you can only go long, you only can go in one direction. The next set of important considerations relate to the cost of investing. Now, ETFs are generally managed more passively, so they tend to have lower fees and lower expenses. Whereas generally mutual funds are actively managed, so they tend to have higher fees and higher expenses. The fees are also more or less known as expense ratios. For ETFs, usually they're around 0 to 0.1% per year. For mutual funds, they are usually higher. They can range from between 0.5% to 1% per year. Now, the numbers may look very, very small and insignificant, but if you think about it over a long period of time, these can really add up quite substantially. So what we see is that it's generally cheaper to invest in ETFs, which are more passively managed. When it comes to mutual funds, there may also be certain minimum amounts that you need to put in order to get invested. Typically, it is at least about $500. For ETFs, there isn't a set minimum amount because you're just buying the shares of the ETF on an exchange. So the minimum investment you need to put in is basically the amount that it costs to buy one share of that ETF from the exchange. Alright, for both ETFs and mutual funds, everything you need to know will be contained in a document known as the prospectus. Now, inside the prospectus, you're going to find information about the fund as well as its manager. So who is the manager of this fund? What is their track record and their investment focus? You're also going to see what is the mandate or the investment objective for the fund. If this fund has been around for some time, what is the performance history of this fund and what have they been investing in? You're also going to find information about the fees and expenses of the fund, and most importantly, the prospectus is required to disclose to you what are the possible risks of investing in this fund. Now, between the two options, mutual funds and exchange traded funds, I think it's pretty obvious that I'm leaning more towards the exchange traded funds, and that's largely because of the lower fees, the lower expense ratios, as well as the flexibility of ETFs that I can invest or trade them at my own discretion. In upcoming videos, I'm going to talk about my ETF general investing strategy and which ETFs that I'm using for that strategy. So make sure you are subscribed if you don't want to miss out on that. But also do note that this is not investing advice, it's just an illustration of what I'm doing. So make sure you do your own research before investing in any particular instrument, be it mutual funds, ETFs, stocks, or any other asset class that's out there. So that's it for today's video. Like, comment, subscribe if you found it to be helpful, and I will see you in the next one.